You know that satisfying feeling when you check your bank account after payday, and for about 11 glorious seconds, you feel like a functioning adult? Yeah, that feeling evaporates faster than your motivation on a Monday morning. And there is a mathematical reason for that. There is a number, a very specific, very uncomfortable number, that explains why you feel broke even when you are technically earning money. And I am going to show it to you right now. But first, I need you to do something. I need you to forget everything you think you know about the average person's finances. Forget the Instagram lifestyles. Forget the LinkedIn posts about six-figure side hustles. Forget your coworker who somehow just bought a boat. Because the actual stats, the real numbers behind what is happening in the average person's wallet, are so jaw-droppingly different from what we assume that when I first compiled all of this research, I actually closed my laptop and went for a walk. I needed air. And I think by the end of this video, you will understand why. So here is the number I promised you. The average American earns approximately $60,000 a year. Sounds reasonable, right? Maybe even decent. But here is where it gets disturbing. After taxes, after housing, after transportation, after food, after insurance, after minimum debt payments, after all the things you literally cannot avoid paying, the average person is left with about $450 a month of true discretionary income. $450. That is it. That is the margin. That is the space between you and everything you want to build, invest in, experience, and become. $450 a month to fund your dreams, your emergency fund, your investments, your kids' college, your retirement, your vacation, your sanity. And most people do not even realize how thin that margin is because nobody talks about it in these terms. But it gets worse. Because that $450 is an average, which means it is being dragged upward by people earning significantly more. The median, the actual middle, is closer to $250 of monthly discretionary income. $250. That is not a financial plan. That is a tightrope over a canyon with no net. And most of us are walking it in the dark, pretending we can see. Now, before you spiral into existential dread, stay with me. Because understanding these numbers is not about feeling hopeless. It is about feeling armed. When you know the terrain, you can navigate it. When you do not, you just wander and wonder why you never get anywhere. So let us go deeper. Here's a stat that should be projected onto the side of every building in America. 63% of Americans are living paycheck to paycheck. Not 63% of minimum wage workers, 63% of all Americans. That includes people earning six figures. In fact, according to a Lending Club report, nearly half of people making over $100,000 a year are also living paycheck to paycheck. Let that marinate. People who would have been considered wealthy by their grandparents' standards are one unexpected car repair away from financial stress. And the reason is brutally simple. It is not that people do not earn enough. Many of them do. It is that expenses have been engineered systematically and deliberately to expand to fill whatever income you have. This is not just lifestyle creep. This is lifestyle engineering by industries that profit from your financial thinness. Think about it. The average new car payment in America is now over $730 a month. A decade ago, it was around $400. Did cars get 80% better? No. Loan terms got longer. 72-month and 84-month loans became normal. You are now financing a depreciating asset for 7 years so that a monthly payment can look digestible, while the total cost quietly doubles. And the average American will spend over $350,000 on cars in their lifetime. $350,000. Put that in the S&P 500 over 40 years, and you are looking at multiple millions. But instead, it sits in driveways, losing value, leaking oil, and financing someone else's yacht. The boat your coworker bought? It was paid for by people making car payments. And housing. Oh, housing. The median home price in the United States has crossed $400,000. The monthly mortgage payment for that home, including taxes and insurance, is roughly $2,800. In the 1980s, the average household spent about 25% of its income on housing. Today, that number has climbed to over 35% for homeowners and over 40% for renters in major cities. We are spending a larger slice of a relatively stagnant pie on a roof, and we have less left over for literally everything else. The math is mathing, and it is not mathing in our favor. Now here is where this gets really psychologically interesting, and honestly, a little dark. The savings rate in America hovers around 4 to 5%. That sounds low, and it is, but the historical context makes it even more alarming. In the 1970s and 80s, the personal savings rate regularly hit 10 to 12%. So in a span of about 40 years, we cut our savings rate in half. But during that same period, productivity per worker nearly doubled. We are producing twice as much value and saving half as much money. Where's it going? It is going into subscriptions you forgot you had. It is going into food delivery apps that charge you $11 to bring you an $8 sandwich. It is going into insurance premiums that rise every year for coverage that covers less. It is going into a financial system that is extraordinarily efficient at one thing: separating you from your money before you even realize it was yours. Let me give you another number that haunts me. The average American has $97,000 in debt. That is not including mortgages. That is credit cards, auto loans, student loans, personal loans. $97,000 of money owed before you even count the house. And the average credit card interest rate right now is over 24%. 24%. If you carry a $5,000 credit card balance at 24% and make minimum payments, it will take you over 20 years to pay it off, and you will pay over $8,000 in interest. You will pay more in interest than you originally spent. The product you bought is long gone. It is in a landfill. But the payment lives on, extracting money from your future self like a financial parasite. Now, I promised this would not just be a doom and gloom marathon, and I meant it. Because here's the part nobody talks about either: the stats on what happens when people actually wake up and start paying attention. People who track their spending, and I mean actually track it, not just glance at their bank app while waiting for coffee, save on average 20% more than people who do not. 20%. That is not because tracking gives you more money. It is because awareness changes behavior. When you see that you spent $412 on eating out last month, something shifts. You do not even have to force yourself to change. The awareness does it for you. Your brain starts running a background calculation every time you reach for your wallet. And here's another one. People who automate their savings, who set up automatic transfers to savings or investment accounts on payday before they can touch the money, accumulate on average 3 times more wealth over a 10-year period than people who save manually. 3 times. Same income, same expenses, same life. The only difference is a 15-minute setup with their bank. That is not financial genius. That is financial plumbing. It is just building the pipes so the money flows where it should before you can redirect it to Amazon at 2 in the morning. And compounding. We all know about compounding. We have all seen the charts. But let me put it in a way that might actually hit differently this time. If a 25-year-old invests just $100 a month, which is less than most people spend on streaming services and coffee combined, at an average market return of 10%, By age 65, they will have over $630,000. $630,000 from $100 a month. But here's the gut punch. If they wait until 35 to start, just 10 years later, that number drops to $220,000. They did not lose a little. They lost $400,000. $400,000 evaporated because of 10 years of saying, I will start next year. Every year you are not investing, you are not just missing gains. You are missing gains on gains on gains. You are missing the snowball. You are standing at the top of the mountain holding a snowflake, while everyone who started early is watching an avalanche of wealth build below them. Let me shift gears for a second and talk about something that will probably make some of you uncomfortable. The wealth gap between people who invest and people who do not is not a gap. It is a canyon, and it is widening every single year. The top 10% of Americans own nearly 90% of all stocks. 90%. The stock market, which has been the single greatest wealth-building machine in modern history, is essentially a private party that most people were never invited to because nobody taught them where the door was. And the crazy thing is, the door is wide open. It has always been open. You can start investing with literally $5 now. But 60% of Americans have no money in the stock market at all. Not because they cannot afford it. Many of them could invest something, even something small. But because the financial industry has made investing feel complicated, intimidating, and exclusive. They benefit from you feeling like it is not for you. Because when your money is not in the market, it is in a savings account earning 0.5%, while inflation runs at 3 to 4%, which means your money is actively losing purchasing power. Your savings account is not saving. It is slowly evaporating. You are paying the bank for the privilege of watching your money shrink. Here's a stat that changed how I think about work and money. The average person will earn approximately $2.7 million in their lifetime. $2.7 million will pass through your hands over the course of your career. That is not nothing. That is a lot of money. The problem is not how much comes in. The problem is how much stays. And for the average person, the amount that stays, the net wealth at retirement, is about $250,000. Out of $2.7 million, only about $250,000 remains. The rest, over $2 million, was spent, taxed, lost, or transferred to someone else's wealth-building machine. You were the pipeline, not the reservoir. And retirement. Let us talk about retirement because the stats here are genuinely scary. The average retirement savings for someone between 55 and 64 is approximately $400,000. Now, that might sound like a lot until you realize that financial advisors recommend having at least 1 to 1.5 million to retire comfortably, which means the average person approaching retirement has less than half, sometimes less than a third of what they actually need. And Social Security, which was never designed to be a full retirement plan, pays an average of about $1,800 a month. Try living on $1,800 a month in an economy where rent alone exceeds that in most cities. This is not a future problem. This is a right now problem for millions of people, and it will be your problem too if you do not act with urgency. But here's what gives me hope, and honestly, it is the reason I make these videos. The stats also show that financial literacy changes everything. A study from the National Bureau of Economic Research found that people with high financial literacy accumulate up to 75% more wealth over their lifetimes than people with low financial literacy. 75% more wealth. Not because they earned more, not because they got lucky, but because they understood how money works. They understood taxes, they understood compound interest, they understood debt management, They understood that $1 saved at 25 is worth $5 saved at 45. They knew the rules of the game. And when you know the rules, you play differently. So let me tell you what separates the people who break out of these statistics from the people who become them. It is not intelligence. It is not income. It is not luck. It is three things, and they are all boring. They are so boring that most people scroll right past them, looking for the secret, the hack, the shortcut. But there is no shortcut. There are only systems. Number 1, they know their numbers. Not vaguely, exactly. They know what they earn, what they spend, where every dollar goes, and what their net worth is to the penny. They update it monthly. They treat their personal finances like a business because that is exactly what it is. You are the CEO of your financial life, and most people are running the company without ever looking at the books. Number 2, they pay themselves first. Before rent, before bills, before fun, money moves into savings and investments automatically. Not what is left over, what comes first. Because what comes first gets funded. What comes last gets forgotten. Every wealthy person I have ever studied or spoken to does this. Every single one. It is the most universal habit of wealth building on the planet, and it costs nothing to implement. Number 3, they invest consistently, not perfectly. They do not try to time the market. They do not wait for the perfect stock. They do not panic when the market drops. They put money in regularly, methodically, and relentlessly, because time in the market beats timing the market every single time in every study across every decade. The data on this is not ambiguous. It is absolute. Consistency wins. Now, I want to leave you with one final stat that I think puts everything in perspective. The difference in lifetime wealth between someone who starts building good financial habits at 25 versus 35 is not 10%. It is not 20%. It is often 100% or more. A decade of good habits of saving, investing, avoiding bad debt, and living below your means can literally double your lifetime wealth. Not because you did anything extraordinary, but because you started. You started when others were still thinking about starting. You moved when others were still planning to move. And here's the truth that nobody wants to hear. You already know most of this. You have heard the advice before. Save more, spend less, invest early, avoid debt. It is not new. What is new is this moment. This exact moment where you decide whether this video is just another thing you watched or whether it is the thing that made you actually do something different tonight. Open that investment account. Set up that automatic transfer. Download that expense tracking app. Cancel that subscription you have not used since March. Do one thing. Just one. Because the stats are clear. The people who win financially are not the ones who know the most. They are the ones who act the fastest. If this video changed how you think about your money even a little bit, hit that subscribe button because I make videos like this every week that are designed to give you an unfair advantage with your finances. Drop a comment and tell me which stat shocked you the most. Was it the $450 of discretionary income? The $97,000 in debt? The car lifetime cost? I genuinely want to know because your comments help me figure out what to cover next, and they help this video reach more people who need to hear it. And if there is someone in your life who is sleepwalking through their finances, send them this video. You might not be able to force someone to wake up, but you can at least set the alarm. I will see you in the next one.